Hello everyone, my name is Starling Barkova Elona from BSBA today, and I am here to discuss Chapter 8. Regular Income Tax Exclusion from Gross Income. Chapter 8, Regular Income Tax Exclusion from Gross Income. Exclusion from gross income. Inclusion from gross income or income which will not be subject to income tax. They are not included in gross income subject to regular tax, capital gains tax, or final tax. Under Section 32BC of the NRSC, the following items shall not be included in gross income and should be exempt from taxation. A. Receipt of life insurance policy. B. Amount received by the insured as return of premium. C. Gift, bequest, device, or descent. D. Compensation for injuries of sickness. E. Income except under treaty. F. Retirement benefits, pension, gratuities, anything. G. Miscellaneous item. Exclusion from gross income. A. Proceed of life insurance policy. The proceed of life insurance policy paid to the heirs of beneficiary upon the death of the insured, whether in single sum or otherwise. However, if such amount are held by the insured under an agreement to pay interest thereon, the interest payment should be included in gross income life in regarding as a capital item with infinite value. Hence, the proceeds of life insurance is a return of capital. B. Amount received by the insured as a return of premium. The amount received by the insured as a return of premium paid by him under life insurance of endowment or annuity contracts either during the term or the maturity of the term mentioning in the contract or upon surrender of the contract. The amount received by the insurer as a return of premium of any insurance contract is return of capital. Hence is excluded from gross income. Illustration 1. Life insurance construct. Alberto insured in a 1 million life insurance policy with annual premium payments of 20,000 from 10 years. If Alberto outlives the policy after the 10 years, will be paid a 500,000 maturity value. Scenario 1. Alberto died on the 8th year of coverage and his heirs collecting the 1 million proceed. The entire insurance proceed 1 million is not taxable. Scenario 2. Upon the death of Alberto, the insurance company negotiated for an extension of the payments of the proceeds within the insurance company should pay 1,050,000. The extended payments that 1 million proceed will not be taxed upon the collection, but the 50,000 exists presenting interest in the taxable item in gross income. Scenario 3. Alberto outlived the policy na collecting the maturity value of 500,000. The total proceeds should be analyzing as total proceed 500,000. Return of premium 20 times 10 years equals 200,000. Return of capital item of gross income 500,000 minus 200,000 equals 300,000 pesos. Scenario 4. After 6 years of payments, Alberto assigned the policy to Galino, who paid him 130,000. Galino continued the premium payments for 2 more years, after which Alberto died, Galino collecting the 1 million insurance proceeds. The assignment for sale of the policy by Alberto to Galino for 130,000 pesos result into 120,000 pesos, 20,000 pesos times 6 return premium, and 10,000 taxable return on capital. The receipt of the insurance proceeds by cleaner result in 170,000 pesos return of capital, 130,000 pesos plus 20,000 pesos times 2, and 830,000 pesos taxable return on capital. There is loss of life in this scenario, but those not retained to purchaser of life insurance policy, hence in the excess must be taxable to the Illustration 2. Life Insurance of Company Officer. Alberto is insured by his employer cooperation for 1 million pesos. The employer cooperation as the beneficiary. Alberto subsequently died and the cooperation collecting the 1 million pesos life insurance proceed. It is interesting to note that the entire proceeds under the insurance agreement are held within the purview of the NRC exception, hence is not taxable. Property insurance contracts. The proceeds of property insurance contracts in excess of the tax basics of the property loss of destroyed is a taxable return of capital. Illustration Property Insurance. Accident Company secure a fire insurance covering the entire 2 million pesos. Fair value of this office building was completely destroyed by fire when the depreciate cost tax basic of the building was 1,800,000. Accident recovering the 2 million insurance proceed. The total proceeds should be analyzed as follows. Total proceed 2 million thousand pesos less basic of property destroyed return of capital 1,800,000 pesos return of capital item of gross income 2 million thousand pesos minus 1,800,000 pesos equals 200,000 pesos. C. Gift, bequest, and device of descent. The value of property acquired by gift, bequest, device, or descent provide, however, that income from such property as well as gift, bequest, device, or income from any property in case of transfer of divided interest should be included in the gross income. Illustration Mark received a restaurant business as a gift on April 1, 2020. On the date, the restaurant had total properties amounting to 400,000 pesos, including 50,000 pesos cash income earnings since January 1, 2020. The restaurant posted an additional 150,000 pesos cash income from April 1 to December 31, 2020. The transfer of business property worth 400,000 pesos to Mark is a gratuity subject to transfer tax, not income tax. However, the 50,000 pesos to net income should be included in the gross income, but in the income tax return of the donor, the 150,000 pesos income of the donating property after the perfection of the donation is included as item of gross income in the tax return of Mark the Don. Gift distinguished from exchange. The transfer intention or motive must be evaluated in determining whether a transfer is a gift or exchange. Gifts are characterized by pure liberality or disinteresting generosity or give without any consideration. Employee gratuities. Gratuities given under employee relationship are normally trading in exchange from service rendered by employee. Hence, they are subject to income tax. The transfer of properties by the employer to managerial or supervisory employees generally is subject to fringe benefit tax. D. Compensation from injuries and sickness. Amount received through accident or health insurance for under Workmen's Compensation Acts and compensation for personal injury or sickness plus the amount of any damage received whether by suit or agreement on account of such injury or sickness. Was awarded by the court a total indemnity of 340,000 pesos divided as follows: 200,000 pesos indemnity for his paid anguish and suffering, 40,000 pesos for his lost salary, and 100,000 pesos as reimbursement for his hospital bills. The 200,000 pesos indemnity and the 100,000 pesos reimbursement for the hospitalization expenses are not taxable return of capital. Note that health is a capital item with infinite value. However, the 40,000 peso reimbursement for lost salaries, a recovery of lost profit, hints on item of gross. E. Incomes of under treaty income items that are excluded by international agreement to which the Philippine government is a signatory are excluded from income tax. It must be recalled that treaty agreement override provision or revenue tax law in the case of conflict under exception doctrine of international committee. F. Retirement benefit, pension, gratuities, and other benefits. Retirement benefit under Republic Act 7641 and those received by official employee or private firms in accordance with a reasonable private benefits plan maintained by the employer. Of exception, economics 1 RPB. A. This is the first time availment of retirement benefit exception. B. The retiring official employee has been at the service of the same employee for at least 10 years. C. The retiring employee is the last 15 years of age at the time of retirement. D. The employee maintain a reasonable private benefit plan. A reasonable private benefits plan means a pension, gratuity, stock bonus, or profit-sharing plan maintained by an employer for the benefits of some or all of his official or employee within contribution are made by such employee for the official or employee or both for the purpose of distributing to such official and employs the earning and principal of the fund thus accumulated wherein it is provided in said plan that at no time shall be any part of the corpus on income of the fund be used for or be divided to any purpose other than for the exclusive benefit of the said official and employee. To be accepted, the retirement benefit plans must be a trusted plan where the fund is held under the management of trusted, free from both employer and employee control. The 10-year service period required pertains to accumulated years of employment. Illustration: Angel was employed in 1990 when she was 25 years old. In 2010, she availed of the early retirement programs of her employer. Angel satisfied the 10 years cumulative employment requirements, but she only 45 years old, i.e. 25 plus 2010 to 1990. At the time of her retirement, the retirement benefits is taxable disease and inclusion in gross income as compensation income. 2. Separation or termination requisite of exception. Number 1. The separation of termination must be due to job retaining, sickness, death, or other physical disability. And number 2. The same must be due any cause beyond the control of the employee or official. A. Redundancy. B. Retrenchment. C. Closure of lawyerly business. D. Employee law of E. Downsizing employer's business. F. Sickness or death of the employee. The phrase beyond the control of the employee connotes a voluntariness of the part of the employee. Abandonment of office such as the registration and subsequent appointment to another office is considered as a voluntary separation does not fall within the purview of the phrase "be for any cause beyond the employer upon termination" be Bureau 003 and 2004. To avail of the tax concession, the employee or his heirs should be request for a ruling of certificate of exception (CTE) from the Bureau. The request for a CTE and other required documents should be filed at the RDO where the employer is registered. Illustration: Yvonne's employee of Goldfish Company, which closing its business during the year Yvonne's last paycheck, showed the following details. Unpaid salary in the last 2 months is 30,000 pesos. Current month salary is 15,000 pesos. Separation pay is 100,000 pesos. Total pay 30,000 pesos plus 15,000 pesos plus 100,000 pesos equals 145,000 pesos. The current month salary at the 13,000 pesos back wage are subject to income tax. The 100,000 pesos separation pay the exclusion from income, hence not taxable. 3. Social Security benefits, retirement gratuities, and other similar benefits from foreign government agency and other institution, private or public, received by resident or non-resident citizen or else come to settle permanently in the illustration. John was an OFW employed microscope corporation in the USA. John retired and returned in the permanently settled in the Philippines. He is paid $2 monthly benefit from the USA Social Security benefit. Both the pension and the Social Security benefits are in sex notes that these benefits were earning abroad when the taxpayer was a non-resident under status rule. The foreign income of non-resident is not taxable in the Philippines. This holds true even if the taxpayer subsequently received the income as a resident of illustration. Mr. Jackson is retired as serviceman from the Iraq War. He receiving a $1,000 monthly benefit from the USPA. The USPA benefit excludes this across income. The same rule apply to USBA benefit from beneficiary of Filipino veteran who fought under the American flag in the World War II. 5. Social Security System or SSS benefit under Republic Act 8282. 6. GSIS benefit under Republic 8291 including retirement gratuity received by government official employee. G. Miscellaneous item. Number 1. Income derived on investment in the Philippines in loans, stock, bonds, or other domestic securities or from interest of deposit in banks in the Philippines by a foreign government. B. Financing institution owned and controlled, enjoying financing from foreign governments. C. International or regional financing institution established by foreign government. These are self-funded by exception the cry of international community income drive the government and its political subdivision from A. Any public utility or B. Exercise of essential government function. This exception does not extend to government owning the controlled corporation GOCCS are generally taxable as regular corporation because their operations are proprietary in the nature. Number 3. Prize and award made primarily in recognition of religion, charitable, scientific, education, artistic, literary, of civic achievement, but only if the receiving was selected without any action of his part to enter the contest of proceeding and the receiving is not required to render submission future service as a condition receiving the prize or award.